Welcome to our third session. We will now turn to talk about tokenization. My dear colleague Hyun Shin will talk about tokenization and the financial system. Hyun is the head of the Monetary and Economic Department at the Economic Advisor of the BIS. He's also a member of the BIS Senior Management and its Executive Committee. Before joining the BIS, Hyun was a professor on Princeton, LSE, and Oxford. So he combines the rigor of an academic with the practical bent of a policymaker. Please join me in welcoming Hyun. So Hyun, then come with me.
Well, thank you, Anna. Thank you for the very nice introduction. Very good to see everyone. And what I'm going to say is going to fit perfectly after what Christine has given us. And in a way, it tries to address what Agustin asked at the end of the session, which is, can we think about the functionalities that come from crypto, but in the regulated financial system. So just a little bit of historical background is useful. If we think about the evolution of money, it's always been spurred by developments in the real economic activity itself. So if we start off with commodity money on the left-hand side here on the slide, I guess we can say that the big advance in the institution of money was the advent of money in the form of entries maintained, entries in account ledgers maintained by trusted intermediaries. The central banks are really the best example of an intermediary. And commercial banks are customers of central banks, and central bank just debits one account and credits another account. So this institution has been around for several hundreds of years. But I guess, in the old days, they were actually literally paper ledgers. You had to write, you had to cross out and then write, new entries. Of course, in the 20th century, all of that became digital. But the underlying rationale was exactly the same. So rather than writing with pen and paper, it's just zeros and ones. I guess what Christine has also shown us is that there is an additional element, and this is the element of tokenization. So tokenization has many different aspects, but the best way that I think that I could understand this is to say it's not only a digital record. So it's not only an account ledger entry, it also combines the rules and logic that governs the transfers. In other words, you can program the digital entry in such a way that you can have the contingent performance of actions. In other words, you can have these if-then statements. So if various conditions hold, then certain activities take place. So the most talked about application of this is in the case of securities markets, which has to do with payment versus delivery. So I would like to sell a security and receive money in return. The buyer would like to buy the security but pay in return. There could be settlement risk, which is, given the sums involved, that could be very, very important. And we would like to mitigate that settlement risk. And one way of doing that is to write a program that says the money goes out if and only if the security comes in. And that's that's the canonical example of how you can use the contingent performance of actions in mitigating risk. Now, of course, tokenization is not the only way of achieving payment versus delivery. We have built up whole institutions to deal with that. And I guess what that shows us is that if an issue is important enough, we will always build institutions that actually take care of that. And I think the issue with tokenization, I think, goes well beyond payment versus delivery. So although that's the canonical example, I think it goes to the heart of this issue. Well, what else can we do with this? And crypto, in a way, has shown us the way. But one thing that Christine didn't mention in her presentation was central banks. And central banks, after all, issue the unit of account, and it's really the focal point of the monetary system. I mean, it really is the foundation of the monetary system itself, and it ensures the singleness of money by settling transactions, across different customers of different banks. And one idea that we laid out in our annual economic report 2 years ago was the idea of a unified ledger, where we not only have central bank money together with commercial bank money, but also with other claims on the same programmable platform. Now, that could be decentralized using DLT, or it could be a bit more centralized as long as we have the governance that backs it up. The technology really is secondary to the idea that you have all of these instruments on the same platform. And the key here is by providing central bank money in tokenized form in the same venue as these other claims, you can actually give full flow to the functionalities of the flow. And actually having public money in this kind of setting is going to be absolutely crucial in order to have the singleness of money and the public good nature of money really sort of providing the benefits. So I think the first use case, which I'll come back to, is in securities markets. But let me give you a second use case, which is something very concrete and something that we're actually doing at the BIS. The picture you see here is the Bank of Amsterdam. Bank of Amsterdam arguably is a very early version of a central bank in that it actually issued fiat money in the very early days. Customers were merchants, just like commercial banks are customers of central banks these days. In the days of the Bank of Amsterdam, merchants were also the bankers, hence merchant banker. And the Bank of Amsterdam played the role of a central bank, a sort of proto-central bank. And what we're trying to do in Project Agora is to really harness this programmability to do something that we do already, but in a much better way. And so what we have done is to assemble 7 central banks, and that includes the issuers of international currencies like the dollar, euro, yen, sterling, and Swiss francs, together with the Mexican peso and the Korean won. So there are 7 central banks. And we've teamed up with 41, and that number sort of varies from time to time, but it's over 40 private sector institutions, mostly commercial banks. And what we're going to do, what we're trying to do is to provide the next generation platform for correspondent banking. So correspondent banking, as you know, is, if you like, the backbone of the international monetary system. And as I said earlier, the key innovation in money is the idea that you can send money by debiting one account and crediting another account. Sometimes that's on the books of the central bank. In the case of correspondent banking, it can be on the books of a commercial bank, a large commercial bank that has international business. And the idea is that we can actually send payments across long distances by having a sequence of these account transactions. So, in this case, suppose that we have firm A that's in the US, firm B, let's say, is in Mexico, or actually, let's say Korea, it's further away. And then we have a sequence of these account transactions. You debit one account, you credit the other account, and then at some point there's also going to be a currency transaction. The problem is that this kind of system is virtually unchanged since the days of the Bank of Amsterdam. So correspondent banking grew up in an era where you relied on the trust of the intermediaries, and the payment system was just the flip side of the trade relationships that existed between merchants. The problem is that we have now grown well beyond this, especially given the compliance requirements. So AML, KYC, all those requirements have been layered on top of a set of institutions that were not designed to handle that kind of burden. And that means that correspondent banking has really been retreating. Now, what Aguilar tries to do is to say, well, rather than have these payments sequentially, why not just harness tokenization? This is going well beyond payment versus delivery. Why not harness tokenization and have all of these account updates happen at the same time? Just one update all the way through, and because of the programmable nature of the platform, you can harness the latest AML, KYC utilities that use privacy-preserving techniques to do the compliance checks all the way through. And this is a very concrete application. Now, let me just conclude with a couple of thoughts, and I'll come back to the securities issue. Now, there are other applications, and in the early days of this discussion, we had many advocates point out that issues like supply chain management or real estate transactions are really the prime cases where you can harness tokenization to have efficiencies. But if you think about those kinds of operations, there are many, many moving pieces and many dependencies. That means that as soon as you have a set of players that you need to bring onto the platform, you can immediately think, well, there are half a dozen other players we need to bring on as well. With supply chains, it's not only the shippers and the bankers who have the letters of credit and so on. Think about the warehouses and then the official sector as well. And then as soon as you have a set of players that you think would be sufficient, think, we forgot about X and Y, so we need to bring them on. And then if you have X and Y, for them, there are other players whose actions are going to be important. Same thing with real estate. There are many, many steps involved in the conveyancing process, and it's going to be very, very challenging to pull this off. So there is this trade-off in that the bigger the potential benefits, the harder it is to actually make tokenization work. I think one of the things that we've learned looking at this issue is that the most promising use cases are those cases where the applications have to do with the update of account ledgers. And correspondent banking is the classic case. But the securities market is also very, very close because centralized securities depositories, or CSDs, are also account ledgers. If you can have the updating of the accounts interlinked with the payments, that's going to give you a tremendous efficiency gain in terms of capabilities. And I guess relative to what Christine has provided, I think this idea that we have central bank money at the heart of such a platform means that you can actually build much more securely. And then if you have central bank money, then commercial bank tokenized deposits in some ways are a much better way of fitting the pieces together. And we can discuss stable coins and how they might differ here. But I think the third part of that trilogy with government bonds, I think would actually complete that triangle in a very nice way. So why don't I stop there, Anna?
Thank you, Hyun, for this very interesting presentation. Let me open the floor and gather some questions from the audience. There is one here, Julio.
Hi, very nice talk and and the summary of the report that you had in 2023. I have one basic question that my understanding is that a lot of the drive between tokenization and cryptocurrencies has to do with decentralized finance, which in a way tries to move away from central channels and away also from government intervention. So there's a liberal type of, or libertarian type of approach, no? So in a way, some of the examples that you give brings back the role of government of some official institutions. How do you reconcile these two views?
I think that's always a very interesting tension in this area, and I don't know whether Chris Brummer is still here, but Chris and I have had many discussions about this. I think in terms of the functionalities, I think there's a very broad continuum. And I think the reason why having central bank money there at the heart of this kind of project is such an important aspect is that we can preserve the best of the current system, especially having central banks who are effectively guardians of the monetary system itself, being there, ensure the singleness of money so that even if you bank with different commercial banks, a dollar in your account is a dollar in your account. I guess maybe I can just spend 1 second on how this would differ with stable coins. I think with stable coins, they are bearer instruments, in that they go back in a way to the commodity-based money that really is at the heart. And there's a broad continuum here with the debates about narrow money, so the difference between currency versus deposit money, where currency is, if you like, it has to be backed. It is hard money. It is narrow money. And I mean, there's a little bit of a difference, I think, with Christine's presentation, in that with commercial banks, we know that yes, they are the core to the payment system, but there is a reason why they have played that role, because going back to the merchant banks of the Bank of Amsterdam, they're a very important liquidity provider as well. So if you have a long supply chain and you want to make a time-critical payment, overdrafts and lines of credit really become a very, very important part of the payment system itself. For manufacturing firms, for example, we know that undrawn lines of credit are larger than drawn lines of credit. That really has to do with the liquidity provision role of commercial banks. So in that respect, I think there's a lot in the current system which has this elasticity, this liquidity provision role, which is lacking in the stablecoin world. And I think this way, our way of doing it would bring back the benefits of liquidity provision role of commercial banks.
Let's see if we have another question from the floor. Yes, Oton?
Thank you, and thank you for the presentation. Going deeper on what you just commented on the nature of the bearer assets of stable coins and tokenization of commercial bank money, which differs in the sense that it's still a ledger with all the niceties that added to the token. When is going to be relevant for the trilogy you talk about having central bank money, tokenized deposits, tokenized government bonds? If I change tokenized deposits for stable coins, losing this characteristic of the commercial bank money and replacing it by the bearer asset, where is going to be relevant for the efficiency of the trilogy?
So I think you have to imagine how a system would look like if you had stable coins. So currently, when someone sends you money, if the sender banks with a different commercial bank, what happens is that the sender's bank debits that account, my bank credits my account, and in the background there is a settlement through the central bank balance sheet. So it's not that I acquire a claim on the sender's bank, my bank credits my account. a stablecoin works differently in that if I receive a stablecoin that has the name of the issuer attached to that balance. So when I wake up and I check my balances, I would have 10 red dollars, 10 blue dollars, 10 yellow dollars. And they're very different. Well, they are different in that they are issued by different issuers. And in that sense, we are departing from a world where money is just money, and there is singleness of money. And this is going beyond, this idea that the banking sector provides, liquidity as a core part of the payment services. A world with stablecoins is the one where you have the cash in advance constraint. There is no such thing as an overdraft there, because a stablecoin cannot, do banking services in the way that banks do. And so it would be very much like the kind of narrow banking model. So if you had narrow banks that do not provide loans, together with, let's say, private credit firms that do provide loans, that would be the kind of system that we would gravitate towards.
Okay, thank you. I think we are just in time for finishing this very nice presentation. Thank you, Hyun. Please join me in giving applause to Hyun.